Your whole life, someone has been telling you to protect your credit score. Your parents said it, your bank says it, ads say it between every video you watch. Credit Karma, Experian, Capital One. And somewhere between age 16 and 22, you absorbed the idea. High score equals financially responsible. Low score equals irresponsible, risky, a problem. Real adults protect the number. That's the deal. There's an entire industry built around telling you to care about this thing. Free score checkers, monthly monitoring alerts, credit builder loans marketed to teenagers. It showed up before you could legally sign a contract, before you had any idea what it actually measured. That mental model? They spent decades installing it in you. And it is almost entirely backwards. Because your credit score measures exactly one thing: how good of a borrower you are for the people who lend money. Not your wealth, not your financial intelligence, not your future, just your usefulness to the lending industry. Here's what nobody told you about who actually built this thing, how it escaped into every corner of your adult life, and why you've been trained to chase it since before you could legally sign a contract. The score is called FICO, Fair Isaac Corporation. Not a government agency, not a neutral consumer protection bureau, a private company. Two guys. Bill Fair, an engineer, Earl Isaac, a mathematician. Founded in 1956 in San Jose, California. Private company, for profit. Now ask the most important question. Who were their customers? If this system was designed to help you understand your financial health, you'd expect them to sell it to consumers, to schools, to nonprofits, to something that sounds like it's on your side. But that's not what happened. They sold it to lenders, to banks, credit card companies, auto loan providers, mortgage originators, to the entire industry whose business model is get people to borrow money, charge them interest for decades, and price the risk so they always come out ahead. The modern FICO score as you know it, 300 to 850, launched in 1989. By the early 2000s, about 90% of major lending decisions in the United States used it. 35 years. From two engineers in a California office selling a product to banks, to the number that now determines where you can live, what you pay for insurance, and in some cases, whether you even get the job. Think about how fast something becomes infrastructure when it's profitable for the right people. It wasn't a public policy decision. It wasn't a regulation. It wasn't a law passed in Congress. Two guys built a risk tool, sold it to the industry with the most money and the most lobbying power in America, and slowly, quietly, it became the operating system of adult life. Nobody voted on that. Officially, none of this is financial advice. My professor told me to say that. He also told me the market is perfectly efficient. Make of that what you will. Now, the most common pushback here is, okay, but I benefit too, right? Better score, better interest rate, I get the apartment. So what's the problem? Fair. That part is real. But here's the trap inside that logic. It assumes that cheaper access to debt is the goal. And it assumes the score is measuring the right things for your life. Let me show you the 5 factors. Payment history is 35% of your score. Did you pay your bills on time? Late payments, collections, defaults, all of that lives here. Makes sense on the surface. Amounts owed is 30%. Specifically, your credit utilization ratio, what percentage of your available credit you're actually using. Below 30% is considered good. Below 10 is even better. Length of credit history is 15%. How long ago you opened your oldest account? The older your accounts, the better. Credit mix is 10%. Variety. Credit cards, installment loans, mortgages. More types of debt means a higher score. New credit is 10%. Recent hard inquiries and new accounts. Opening several accounts quickly signals risk and drags the number down. Now step back and look at what this list is actually measuring. Are you paying your debts? How much debt do you carry relative to your limits? How long have you been carrying credit accounts? How many different kinds of debt do you have? Are you taking on more debt recently? Every factor, every single one, is about your relationship with debt, not your savings balance, not your investment portfolio, not your emergency fund, not your net worth, not whether you own anything that's growing in value. None of that moves this number. You could have $200,000 in a brokerage account and a paid-off car and a fully funded emergency fund. None of that matters to your FICO score. 0. But if you have a credit card from sophomore year with a low balance, and you've been making minimum payments on a car loan for 4 years, You're golden. And here's the street translation, because I need to say this plainly. When they say credit score, what they actually mean is debt reliability rating. It is a score of how reliably you borrow money and pay it back over time. That's it. It was designed to measure exactly that, because the people who paid for it needed exactly that information. Let me make this real with two people. Meet Marcus, 26 years old, works in IT support, makes $64,000 a year. He's been financially disciplined since freshman year, paid off his student loans in 26 months of aggressive payments, bought his car with cash, a used Civic with 110,000 miles on it, never carries a credit card balance, emergency fund is fully funded, 6 months of expenses, puts 15% of every paycheck into retirement accounts. By every reasonable measure, Marcus is doing the right things. What's his FICO score? If he's barely used credit, it might sit in the low 500s. If his accounts have been inactive long enough, he might be credit invisible, which means no score at all. The system literally cannot see him. He's a ghost. Financially responsible, statistically invisible. Now meet Tyler. Same age, makes $51,000 a year, has a credit card from freshman year, a car loan he's been paying on for 3 years, and federal student loans with consistent minimum payments. 3 types of debt. 5 years of perfect payment history. Tyler's score? Probably 740, maybe higher. Tyler has over $38,000 in outstanding debt. Marcus has 0. The system rates Tyler as the more financially trustworthy person. Sit with that for a second. Because this is not a glitch. This is the system working exactly as designed. Lenders don't want to lend to Marcus. He doesn't need their product. He's not revenue. Tyler, on the other hand, is paying interest on 2 loan products for years. Tyler is a customer. The FICO score rewards Tyler because Tyler is valuable to the people who use FICO scores. It is a customer quality metric, and you are the customer being evaluated. The score doesn't ask whether you're building wealth. It asks whether you're a reliable participant in the debt cycle. Those are 2 completely different questions, and nobody told you which one they were actually asking. Here's the deadlock. Let's say you hear all of this and you think, fine, I'll just be strategic. I'll build my score high enough to get what I need, then stop caring about it. Reasonable plan. Watch what happens when you try to execute it. You open a credit card, use it for small purchases, pay it off every month. Score climbs slowly, 680. 700, 710. Then your oldest account, a card from years ago you barely use, starts charging an annual fee. You don't need that card. You paid it off. You close it. Score drops. Because closing that old account shortens your average credit history length, which hits that 15% factor. The system just penalized you for closing a debt you already paid. So now you keep the card open. A credit card you don't need. Paying a fee. For a score you were trying to stop obsessing over. Because the system punishes you for cleaning up. Or let's say your score is decent, but your credit mix is thin. Just one card. You hear that an installment loan would help the mix factor. So you take a small personal loan for something you technically could have paid cash for, just to diversify your portfolio of debt. You now have debt you didn't need, paying interest you could have avoided, to impress a scoring algorithm designed to keep you borrowing. Or let's say you moved cities. You're looking for an apartment, and the landlord requires a 650 minimum score. Your score is 640. One collection from a medical bill 3 years ago that you've already paid. Already resolved. Still dragging the number. Collections can stay on your report for 7 years, regardless of whether you cleared the balance. So you have a paid debt from 3 years ago blocking your housing options today. The leash doesn't just hold you. It trains you to hold yourself. And this is where the childhood indoctrination piece gets real. You were taught this number matters before you understood what it actually measured. The mental model got installed first. The mechanics came later, if ever. Most people in their 20s can tell you that you should keep your utilization low and always pay on time, but they cannot tell you who invented the system, who their actual customers are, or why the algorithm rewards carrying multiple types of debt instead of having no debt at all. They know the rules of the game. They just don't know who wrote them. Or why. Now let me show you something on the wall here, because this is the part that really should make you stop and think. The score started in lending. Lenders need to price risk. Fine. But the score escaped that box a long time ago. In many states, insurance companies can use your credit score to set your premiums. Not your claims history, your credit score. The statistical argument is that people with lower scores file more claims on average. So even if you've never filed a single claim, a low score can raise your car insurance or home insurance costs. You're paying for someone else's statistical pattern with your money. Landlords run credit checks. In competitive rental markets, a score below 650 can disqualify you from an apartment regardless of your actual rental history. One difficult financial period 3 years ago, and the building you want now turns you away. That landlord doesn't know what happened to you. They just see a number. The number tells a story. But the story was written by an algorithm that doesn't know your story at all. Some employers, particularly in financial services and government contracting, run credit checks during hiring. The reasoning is that financial instability predicts certain risks. Whether the research actually supports this? Let's say the evidence is less than convincing. But the practice exists, which means a rough financial period can cost you a job offer 3 years later when you've fully recovered. The score follows you. Through the rental market, through insurance pricing, through employment screening, through every lending decision for the rest of your adult life. And the entire ecosystem behind this is enormous. 3 major credit bureaus: Equifax, Transunion, Experian. They collect your financial data and sell it, not just to lenders, to insurance companies, employers, background check firms, and data brokers of all kinds. Equifax had roughly $5 billion in revenue in recent years. Transunion, around $3.5 billion. Experian, over $6 billion. They collect something valuable that you generated with your financial behavior. They sell access to businesses. Then they turn around and sell you a subscription to monitor the data they're already selling about you. They sell it to corporations. Then they charge you to see it. In 2017, Equifax experienced one of the largest data breaches in history. The personal information of approximately 147 million Americans, including social security numbers, birth dates, addresses, and in some cases credit card numbers, was exposed to unauthorized parties. The company had collected all of that without you opting in. Then they failed to secure it, and the penalty they ultimately faced was less than the revenue they generate in a single quarter. FICO profits from every score pull. The bureaus profit from every data sale. Lenders profit from pricing you precisely, extracting maximum interest while minimizing their exposure. And you were taught to protect the number that makes all of this possible. So, what actually changes when you understand this? Because here's where I have to be honest with you about something. You cannot just opt out. The leash is real. The consequences of a low score in this system are real. If you need to rent an apartment in most cities, you need a functioning score. If you ever want a mortgage, you need one. If you're in a state where insurance companies use credit scoring, it affects your premiums whether you like it or not. The answer is not to refuse to play the game. The answer is to understand what game you're actually playing and to play it consciously, with the minimum required investment of your attention, while redirecting your real financial energy somewhere that actually matters. Here's the key insight. Stop treating your credit score as a measure of your financial health. It is a measure of your usefulness to the lending industry. It can be useful for you to know, the same way knowing a store's return policy is useful, but you don't optimize your entire financial life around the store's return policy. Your actual financial health lives in one number: net worth. Assets minus liabilities. What you own minus what you owe. 2 people. Both have a credit score of 740. Person A has 180,000 in assets and 30,000 in debt. Net worth, 150,000. Person B has 25,000 in assets and 42,000 in debt. Net worth, negative 17,000. Identical leash scores. Completely opposite financial realities. Net worth tells you whether you're building wealth or managing the appearance of it. Track that, not the leash score. Here's the actual protocol. 1. Game the score. Don't worship it. Keep 1 or 2 credit cards open. Pay the full statement balance every month, not the minimum, the full balance. Keep utilization below 20%. Don't open new accounts unless you have a specific reason. Don't close old accounts unless there's a fee you can't justify. That is the entire strategy. It takes maybe 15 minutes of attention per month. Do that and move on. 2. Stop checking your score compulsively. Pull your free credit reports from each bureau once or twice a year, not to obsess over the score, but to check for errors. Credit report errors are more common than people realize, and they cost you money in higher rates. A study from the Federal Trade Commission found that roughly 1 in 5 Americans had a material error on at least one of their credit reports. An error is worth finding and fixing. The score number itself does not need your weekly attention. 3. Track net worth monthly. A simple spreadsheet. Assets on one side, every liability on the other. Subtract. Watch that number move. Set a calendar reminder for the first of every month. 5 minutes. That is the vital sign. That is what tells you if you're winning. 4. Before any new debt, calculate the total cost, not the monthly payment. A $22,000 car loan at 8.5% over 60 months costs you nearly $5,000 in interest alone. Is that car worth $27,000 to you? Because that's the actual price. The dealership will show you a monthly payment. That number is designed to feel manageable. Always ask the total cost question before you sign. And 5. Your situation is yours. The patterns I'm showing you are real and they repeat. But before you restructure anything significant, talk to someone who knows your complete financial picture. I see the patterns from outside. You have the details that change everything. Here's where we close the loop. Back at the beginning, I told you that your credit score has almost nothing to do with how wealthy you are. Now you have the full picture. Fair Isaac Corporation built the system in the 1950s. The modern score launched in 1989. By the 2000s, it controlled access to most credit in America. Then it spread into insurance, into rentals, into employment, into the infrastructure of adult life. It measures your relationship with debt. It rewards you for maintaining multiple types of debt for as long as possible. It was built for lenders, sold to lenders, and optimized to serve lenders. 3 bureaus became billion-dollar businesses collecting your financial data and selling it back to the same system that created the score, then charging you to monitor what they're already selling about you. And an entire generation was taught to protect this number as if it were a report card on their financial worth, when it was always just a rating of their value as a debt customer. The indoctrination started early, before you had income, before you understood interest, before you could even sign a contract. The lesson came first, and the fine print never followed. The leash is real. The consequences are real. You have to deal with this system as it exists. But here's the move they really didn't want you making. Understand the rules. Play the game with minimum attention. Then redirect your actual financial energy toward net worth, not toward optimizing your borrower profile for someone else's benefit. Your score is a tool, not a report card, not a measure of your worth, not something you owe loyalty to. A tool. Use it when you need it. Maintain it with 15 minutes a month. Then put your real attention on the number that actually tells you where you stand. Use the system. Don't let the system use you. Because there is a difference between understanding the leash and wearing it. Don't let them play you. Listen to what they're actually saying.